Welcome to This Explainer. Look, today we are completely shifting your paradigm. If you are just exhausted by obsessively trying to predict market direction every single second, well, you are in the exact right place. We're going to strip away all that hype today and focus on the pure mechanics of time and liquidity. It is time to learn how to calmly execute within structured institutional time windows. So here is our roadmap. We'll kick things off by looking at the illusion of direction, then explore exactly why timing is your ultimate filter, and uncover the institutional power of 60. After that, we'll map out how markets pair orders, pinpoint your high-probability trading windows, and finally, build the mindset of a truly emotionally neutral operator. All right, let's jump straight into part 1, the illusion of direction. We have absolutely all been there, right? You feel that heavy payout pressure, the sheer frustration of missing a move. So what do? You chase a massive green candle. You force a trade based purely on the fear of missing out, only to watch the market immediately reverse and hunt your stop loss. It feels incredibly personal, but I promise you, it's just structural. You were trading without context. And that perfectly highlights the great divide in trading. On one side, you have emotional retail participation, chasing breakouts, revenge trading after a loss, and acting with this desperate emotional urgency. On the other side, though, you have structured professional execution. Institutional operators thrive by doing absolutely nothing until the environment perfectly aligns. They operate with selective participation and deep emotional neutrality. Which brings us to part 2. Timing is the filter. There is a very true saying in this industry. Only timing survives the noise. Because the market, it's not a random walk. Price movement outside of scheduled liquidity windows is very often just algorithmic noise. It's literally designed to induce the exact emotional mistakes we were just talking about. This brings us to a really foundational concept called order pairing. Think of the market as a highly efficient scheduled matching engine. Institutions simply cannot execute massive size in an empty order book. Every single large buy order must be matched with a seller. Because of this, price is intentionally engineered to drive straight into liquidity pools, which is exactly where retail stop losses happen to be resting, simply to facilitate these massive institutional transactions. Let's break this timing down further in part 3, the power of 60. You see, every hourly candle follows a highly repeatable institutional rhythm. From minute 0 to 12, we have accumulation. Direction is intentionally kept unclear as positions are quietly built. Then, from minute 12 to 20, is manipulation. This is the false move, the liquidity sweep, designed specifically to trap reactive traders. And finally, from minute 20 to 45, we see distribution. This is the true expansion phase, and without a doubt, your absolute highest probability environment to participate. Let that sink in for a second. During those first 20 minutes of accumulation and manipulation, sitting completely still on your hands is your true edge. Protecting your mental capital while the trap is being set is incredibly difficult for an emotional trader. Doing nothing is actually a high-skill activity. It's what protects your capital for the actual expansion phase. Moving right along to part 4, how markets pair orders. So where exactly do these orders rest? Well, buy-side liquidity usually sits right above old unresolved highs. Sell-side liquidity is engineered beneath failure swings. When price suddenly shoots toward these levels, those false moves trap the breakout traders. And once institutions pair their orders using that retail liquidity, price reverses to rebalance fair value gaps. Once you start seeing this, you'll naturally stop reacting to single candles, and instead, you'll start anticipating where the true orders are actually waiting. Now let's talk real-world application in part 5, high-probability trading windows. Consider this your concrete operational manual. We are not trading all day long. The Asia session from 8 p.m. to midnight Eastern forms the primary dealing range. Then London, specifically from 1:12 a.m. to 2:12 a.m., engineers the liquidity sweep of that range. And the early New York window from 8:12 a.m. to 9:12 a.m., well, that's typically where the primary directional expansion occurs. These specific time-based windows are literally the only environments where conditions are actually worth risking your hard-earned capital. Within those specific session windows, your execution has to be absolutely mechanical. Step 1, wait for that 20 to 45-minute distribution window we talked about. Step 2, confirm that an order pairing liquidity sweep has actually occurred. Never just anticipate it. And step 3, only execute when you see clean 3-candle displacement. It is a strict, completely unemotional sequence. Following this sequence requires immense, unwavering discipline. It requires you to ruthlessly grade your setups, aiming for that strict pre-trade score of at least 45 out of 70 before even thinking about clicking a button. You are hunting for A-plus environments, only participating when probability, market structure, and institutional timing perfectly converge. Because at the end of the day, patience creates precision. Finally, let's tie it all together in part 6, the emotionally neutral operator. You absolutely must internalize this hierarchy. Survival comes first. Protecting your capital and your mental clarity is always your top job. Second is risk control. If you get stopped out during that manipulation phase, you never re-enter emotionally. You step away. Third is process. Maintaining a strict emotional neutrality score. If you are tilted, you're done for the day. And finally, profit. Profit isn't the goal to aggressively chase. It's simply the byproduct of compounding small, boring wins over quarters. Look, a trader with a fully funded account but a destroyed mental state is simply losing in slow motion. As we wrap up this explainer, I want you to really think about this ultimate takeaway. Sustainable trading is about consistency of self, not perfection of prediction. So ask yourself, are you ready to abandon that exhausting need to predict every single tick? Are you ready to patiently wait for the perfect time? Because when you master your timing, you truly master the market. Keep your charts clean, keep your mind clear, and I'll see you in the next one.